75 basis points.
Mm-hmm.
Last week, I described that our view is that after the volatility of the next few months, that the market should end the year higher than it levels before the pullback. That does remain our base case. The reason for that is we believe that recession fears are overblown. That recessions are typically triggered by financial crises, and we don't see that happening right now. Although the concerns about the carry trade in Japan are something worth looking at. But we don't see what the Fed would gain by cutting rates by a quarter of a point or even a half a point now, or what the delay of waiting till September, where Powell indicated that they were likely to move, what that would do for the economy. So we think a lot of the fears are overblown. When I was preparing the remarks over the weekend, on the presentation over the weekend, I was going to use the alternate title of "It's time to take a deep breath and then exhale before we start overreacting to what's going on." So let's jump right into what are the factors that are driving the concerns, and how should we think about moving forward? So obviously you can see the VIX is spiked quite a bit. This is the fear gauge for the market. This is as of Friday. Obviously, it pulled back in. Actually, this is as of yesterday. It pulled back in a little bit today. But these are not normal times, and these are unusual levels. I think there are a couple reasons for this spike, which we'll touch on in one sec. Really, the first one is recession concerns, and that followed the recent unemployment report in the U.S. that kind of spiked that. And then you add to that the concerns from the earnings coming out from big tech on the return on investments on AI. And then we have all the other risks that are present in the system. And one of the big ones is the threat of expanding conflict in the Middle East. The retaliation that's expected from Iran towards Israel for the very effective attack on somebody deep inside a protected area in Iran is troubling and requires a response. We are seeing wild moves in the currency and rate markets, but you also have national security issues still front and center. Then you have the threat of cyber attacks, but also just cyber failures, as we saw in the last couple of weeks. And then you have the election issues that exist today. So you add that all together, and it creates a kind of a witch's brew at a time that there are a lot of, this void of a lot of things that are going to move the markets in a very positive way going forward. So earnings have been okay, but not great. And even when the big tech companies reported, they were reporting a decline in their growth rates from exceptionally high growth rates, and that was kind of hard for the market to digest. So a lot of issues. We're going to touch on some of these and what our thoughts on what's driving it. So starting with the carry trade is getting a lot of attention. And, the Nikkei, this was from yesterday, had its worst day in 37 years, followed by its best day today in history. So it was down about 12%. That was up over 10% today. This is the trouble with getting too carried away with single data points, and you can't overreact in different market periods. But clearly, Japan is moving off of very negative rates for a long time. And at the same time, many parts of the rest of the world, central banks are lowering rates. That's putting them in a very difficult position for how to think about the markets. If you're moving up in rates, it's going to squeeze multiples. You have the currency issues working against them. So there's some challenges there. But I think this is really the market searching for a reason to unwind a very loaded trade where everyone was on the same side of the boat. And I think that's the same thing you're seeing in some of the Magnificent Seven stocks. As a result of the concerns that you had, we've had some very significant declines in rates. And this is not just in a week. We had the 2-year drop 44 basis points, the 10-year drop 34 basis points. And since its high, the 30-year, the 10-year has dropped 74 basis points in about 3 months. So these are very significant moves. So why does the Fed need to move right now when the rates have come down quite a bit and the yield curve has gotten more normalized? Is not quite clear to me because the market's doing a lot of that work for them. Similar in the mortgage area, we saw mortgage rates drop from 7.8% in October of last year to now they're down 6.73% on the 30-year fixed for the US today. That's a 1% drop, over 1% drop. That's actually given people on a typical mortgage in the US what was back in October just shy of $2,250 a month mortgage payment is now $2,000 a month for that same house. That's a pretty significant shift down, and that does increase affordability quite a bit for people. So the calls for the Fed to cut rates while the market's doing the work for them don't make a lot of sense to us. And this is part of the normalization that we've talked about of the market adjusting to higher yields, moving off of zero interest rates that have been going on for some time. So this, I didn't check today, but this was the market calls as of Sunday for rate cuts, and they're looking for a 50 basis point cut in September. We heard 75 basis points. Jeremy Siegel was on CNBC yesterday saying they should do 75 immediately. Nick Tirmos from the Wall Street Journal, who's been viewed as the Fed whisperer, was out today saying he doesn't see an off-cycle move and he doesn't see the need necessarily for the Fed to go beyond what they already said they were going to do. Yes? I'm sorry, was there a question?
No.
Okay. So I think that our view remains intact. I think September is on the table. If they moved more, it would be viewed as highly political. I don't think Powell plans on being political at all. I think he's going to do what he thinks the right thing for the economy is. And I don't think he sees the recession fears that everyone else sees right now. If he did, he would act faster, but he doesn't see the need to do that. I would be shocked if they do something sooner, but if you have a financial crisis hit before then they would act, but I don't see that happening necessarily. And I think the Fed meeting in Jackson Hole will give people a better sense of where the world's going forward. But the ECB's been concerned about a spike up in inflation. A lot of the policies in place that politicians, both Harris and Trump, are talking about would be inflationary. And I don't think the Fed's going to react to that, not knowing who's going to win, but it is in the back of their mind how they have to deal with that. Another big issue that caused a lot of concern was the unemployment rate, but weather might have been a factor, a considerable factor in that, which was the first storm we had, Hurricane Beryl, which came through. And in the report, there was weather-related problems with workers. 1.54 million workers were either not working or working part-time due to weather in this report. That tends to not be a permanent factor. There are some alarming things in the unemployment numbers, like Intel calling for 15,000 layoffs. But we've talked about this last week. The tech companies overhired in the pandemic to secure the talent they needed, and now we're letting it go. So I think there is some normalization here, but we had 117,000 jobs added. That is not the sign of a recession. It is a sign of a slower hiring period. But again, if weather was a factor, that could be absorbed pretty quickly back into it. And we are still growing the unemployment rate in a manageable way. But I looked at the 70s, 80s, and 90s unemployment numbers, and you don't see a lot of 4% numbers. You see a lot of 5, 6, 7, and 8% numbers in that time frame for the unemployment rate. So this, to me, is just part of the normalization of the U.S. economy following the stimulus that was put in following the great financial crisis. Then again, with the pandemic, we've had these unusual adjustments, and we're getting back to a more normalization here. So I think that the concerns about the employment rate, as this is being a trend, we need to see it become a trend, not a data point. I would just point out the other issue on unemployment is the move up has triggered what's called the SOM rule. And that says that if you move up basically 0.5% of unemployment over a 3-month period, that's the sign of a recession. And even the Professor Sam, who came out with this concept, said she doesn't know if it's going to work in this environment because of all the distortions. So I think we're reacting to historical things in an unprecedented environment and using that as a given when it's not necessarily, and it's going to lead people to bad decisions and overreactions at a time they shouldn't do that. So switch gears, we had the other issue that was weighing on the markets, which was the NASDAQ, and particularly the Magnificent Seven moving. And the NASDAQ had moved into correction territory. But look at the chart. This is not necessarily a desperate chart that, from a technical perspective, it does say that there's more room for downside, because I think if you did the lower band, it would show that we've broken through the trend line. But I think that could reverse itself quite quickly. And I wouldn't get overly dramatic on the technicals here, but I do think this is a normal correction after a very strong move in a market that got driven up by a couple names. So the Magnificent Seven are down a bit, and you can see from July to 11th to now, they have taken 5, 10 greater hits, and some of them have been the biggest names like NVIDIA. NVIDIA had a 3-month delay on one of its chips. I think that is a cause for concern, but not a cause for an overreaction. And we think they're just pulling forward a delaying demand that's going to come to them anyway. But I think you are seeing a divergence in the Magnificent Seven and their fortunes. They have other issues that are starting to weigh on them. I think it was a too crowded trade, and it was very easy for some of the hedge funds to reverse themselves, and their concerns about getting ahead of other tax loss selling was something that I think was going to come. But the real issue gets to questions about their return on investments versus their spend. But now we're seeing increased antitrust issues, increased regulatory scrutiny, and then the geopolitical events, whether you're seeing the impact on an Apple or Microsoft on access to China and markets, as well as for NVIDIA. Less of a concern for Alphabet and Meta and Amazon, who we're not getting as much of their business, but a bigger concern for Tesla as well, how they play in some of their bigger markets that are now becoming more adversarial. But I just wanted to step back and take a look at the mentions of AI, because it's the return on investment on AI that's really creating some concerns for people. But going back to 2000, you can see from the Magnificent Seven companies, excluding NVIDIA, their conversations on AI with NVIDIA would be on every call. But just look at the increased number of mentions on their earnings calls each quarter, and that you can get a sense of how fast it grew and how important it is today. Which brings me to the big debate on Wall Street is, are they going to get their return on investment or not? And I thought these quotes from Zuckerberg and from Google were quite interesting, in that they believe the risk of not spending now and waiting creates a 10 to 15-year problem for you, and that underinvesting is a far greater risk than overinvesting in this period. But I thought the comments from the Microsoft Morningstar analysts were really interesting, because there's a lot of comparisons back to the tech bubble. But one of the most important parts is the last sentence. The main difference, though, is the firms doing most of the building have massively profitable existing businesses and fortress-like balance sheets. To compete with these guys on their spend, when they can divert big spend on their I forget what Google and Facebook were calling their big bets projects, but they were spending $6 to $8 to $10 billion a year that they can easily divert from those spends like the metaverse to AI and get a bigger return on investment, when other companies that are with less profitable businesses with weaker balance sheets are seeing increased interest costs, particularly for those highly indebted companies. And you get this divergence that I've talked about for some time between the have and have-nots. So I think it's too soon to know who gets the return on investment best. But I think the overreaction to, are they spending too much, might be something that people want to rethink, because I think they have the wherewithal to do it. I think their profitability of their existing businesses allows them to keep spending, and their balance sheets give them an ability to differentiate from everybody else. I also think the real opportunity is going to be who can apply AI best to get the best return on investment. And I do think that what Meta can do, what Apple can do, where they've proven their ability to take technologies and get the return on investment from them, and monetize them exceptionally well is something people should keep an eye on, because there's a lot of negativity towards some of these companies, less so for Meta, but more so for Apple, and some of the others that I think is going to be a difference. But this will be the determining battle. This is the battle line that's being drawn in the analyst market and in the portfolio managers as to how they think about this going forward. But I think this is a really important element that we can't overlook of how this spend's going to work. And when you back it up with how they're actually spending, and you look at these numbers, and these are quarterly infrastructure investments to support their AI and their CapEx from 4 companies, Microsoft, Meta, Amazon, and Alphabet. And you think about this spend relative to what the rest of the S&P 500 can afford to spend. And you can see how these guys can create a moat that is going to be very hard to compete against unless they completely trip over themselves in the process of doing it. And their track record of success would say that they're not in the same boat as a lot of the companies that failed coming out of the 2000 time period. So I'm going to wrap up, Mark, with this. As I said last week, that we think market volatility should persist through the election. You have Harris making her announcement today on her candidate. That's an interesting pick. I think it's going to be less controversial than maybe if she went with Shapiro or Mark Kelly. I think this one is a more neutral pick for her. It does kind of move it more towards the middle a little bit. But I think the really important point is we're going to have that volatility. You have the Jackson Hole meeting. You have potential debates coming. I don't think vice presidential candidates make that big a difference after you get through this period. And while a lot of things are favoring Harris, I think she's still dealing with some of the halo of her getting appointed and now getting what looks like the support that she'll need to get through. So I think we're in a spot now where you have this period of 90 days where the election is going to sort itself out. I think the big issue, and this is one of the key points from Powell's press remarks, is that they're going to be data dependent, not data point dependent. And for that, he was referring to the Friday job, any single jobs numbers, or any single inflation numbers. He needs to see a trend before he's going to react, particularly given the tenuous nature of where we are with the election, with where we are with monetary policy and the potential fiscal policy. So we think that there will be a Fed easing that will spur a rally. You'll also get clarity around the election that will help ease some of those concerns and give you a better direction and less uncertainty, which should drive us forward. I think the short-term focus is masking some real concerns. And you had some headline news like Buffett selling big stakes in Apple and B of A that people react to, but they had oversized positions that in both those stocks that you might not want to hold if you think things are starting to transition or slow a little bit. You would pull back from that, but that's kind of normal. I think people are overreacting to that. I think they're still missing the fact that power of what the federal spending in the U.S., supported by state and local government spending, is going to do, which is going to be further supported by corporate CapEx, particularly some of the spend, like I showed you, from the big tech companies that are going on. But also there's a lot of spend going on by small businesses and other businesses, either in new startups or in trying to improve their productivity to deal with rising labor costs. We're seeing that in the fast food area, we're seeing that in retail areas where they don't have pricing power. They're going to start substituting capital for labor. So we think the best opportunities are still in the areas of required spending, which is defense, energy, infrastructure, healthcare, and all the moves to increase productivity. So Mark, I'm going to stop there and open it up for comments. And I know we have Jim Carroll has some interesting slides on volatility that his group's done. So Mark, I'll turn it back to you.
Yeah, let's take a few questions real quick. Then Adam, I saw Britt, you had your hand up too, so feel free. Adam, go ahead.
Thank you, Stephen. My question, I wasn't clear in the presentation that you made. Are you expecting a rate cut? Yes, no. What amount? And if it doesn't happen in September, what would be the next opportunity for them to do that rate cut without calling a special meeting?
The day after the election is the next opportunity. I think they will move in September, and I don't know that they have to do much more. I think the economy is stronger than the market thinks, but I think we need more time to see how it plays out. But they can go in September. There is a meeting the day after the election, I believe, that they can have an announcement at that time if they wanted to. Then they could also go again in December. The market, I think, is pricing in cuts at the next three meetings of 25 basis points at least. And I just don't see the need for that unless we have a financial crisis. But I suspect that the unemployment numbers will be more of a distortion than a trend.
Thank you, Stephen.
You're welcome.
Anthony? Unmute. Still muted.
Okay, there we go.
There you
Yeah, Stephen, some of the unrest we've got here in the UK, do you see that spreading to other regions in the US?
I think the unrest you're seeing in the UK is unrest that you're seeing in other places. I don't know if you saw the Prime Minister of the Netherlands gave a pretty inflammatory speech about how we should be worried about the same thing happening here. I think this is really just the ongoing political divisiveness that we have around the world, and I think it's rooted in bad policies and frustration about how people are progressing in their lives. And I think that in the UK, you have a situation where you need to see better growth. You're starting to see some, but you need better policies. And I think a lot of the frustrations are a reflection of bad leadership for a long time, not just in the UK, all around the world. And that's led to frustrations from populations without really good discussions on how to solve the issues that are really creating the problems. How do you bring people into an economy and into a country and assimilate them into a system that allows them to be productive, not destructive? And I think the negativity around the populism around immigration is a bigger problem than the actual immigrants themselves. I think if you had a better process to bring them in, they're necessary in most of the countries that are complaining about them because of the population declines that they're seeing. And if it wasn't such a volatile week, I was actually thinking of doing a thing on the population changes, because I think if the public really understood how bad it is with their age dependency issues and other things, I think they'll see that most nations are on an unsustainable path for managing their retirees going forward. So I think immigrants are going to be necessary in most of the developed nations at a much better, higher pace than we're getting them now. So I think we have the opposite problem that people think.
Take the argument precisely. Yeah. Thank you.
Any
Which
other-
is not, it's not a popular view, by the way, in a lot of places.
I can see both sides of that proverbial coin. Yeah, the assimilation rate is not working here at the moment. That's the problem.
And there is an element, and we talked about this in our morning meeting today at ARS, is there's an element of if you go to another country to participate in that way of life, then you have to accept that some of your old way of life you have to give up and accept the norms of that country. And I think that's where part of the standoff is coming from, is people want to move to different nations and keep everything the way they had it in the place they wanted to get away from. And I don't think you can do that. And so I think both sides have to have different levels of expectation and work towards how they assimilate.
Well, inevitably, simulation goes on both sides of the fence. So it's how do you manage the expectations and then control the outcomes?
That's better leadership, quite frankly.
I agreed. Yeah, we've been lacking that here for a long time on this subject.
And you don't corner the market on that there.
Don't worry, I know nothing.
So I want to switch over to Jim, but just before I do, since we're heading back to London, these briefings all came about because of the September 2019 conference in London, where Stephen shows up at, like, he's the first one there. He's got all the newspapers. He's read them. He doesn't hold them. And we start talking about what he's just read about. And this is I think it was Rich Sobel said, you might want to let Stephen talk at the beginning of these conferences. And the question at the time, remember the question was, is global
Climate
warming,
change inflationary or not?
yeah, inflationary or deflationary? And I think the answer, of course, with Stephen, it was both. But it's like Machiavelli, is it better to be loved or feared? Both. Anyhow, but I was just thinking as it popped on the screen. But let's switch over because what Stephen does well is
That
catalyze.
benchmark was short-term inflationary and longer term, it should be deflationary if we got it right. But
I remember that.
We haven't got it right.
Well, it also requires infrastructure spending, but we haven't gotten that right either. Back over then over to you, Jim, because you saw the word volatility on our weekend digest and said you had just published a piece on this, so it's timely that you could share some slides. And speaking of slides, I will yield slides to you.
Can you see them?
Yep.
Great. And I'll run through this quickly because Stephen touched on a number of the important elements, but what the hell just happened? In summary, we saw a continuation of what had been a bull run, notwithstanding the April pullback through mid-July. Stephen mentioned the yen carry trade. I'll show that graphically. Geopolitical concerns. We had a streak of S&P 500 without a 2% down day that was broken, a VIX streak of daily closes below 20 that was broken. In addition to the carry trade, we've also seen an unwind of some volatility trading and vol control funds that need a certain amount of need to manage their vol. This is what we looked like. Sort of the red line is June 30th. So we made some new all-time highs in July before we hit this slippery patch. 356 trading days without a minus 2% close in the S&P. Got to go all the way back to post the internet bubble to match that. VIX closes below 20. 20 is the long-term average for the VIX, and that streak was not historic, but it had coincided with that S&P streak, and we had a pretty calm market. This is the carry trade. If you look at US dollar yen against the triple Qs, the NASDAQ 100, they had been going up in a straight line. And as soon as the yen decided to strengthen, we saw stocks go the other way. We had VIX at the end of June at 12. By Friday, it had doubled to just about 23. And then over the weekend, Asian markets went limit down Sunday night, US time. Demand for the put options in the S&P 500 that are how the VIX is calculated went crazy, creating a squeeze that took the VIX north of 60. That was the highest level we've seen outside of the GFC and COVID. And I think what's important here is, I go back to that slide for a second. It's the VIX moves higher when the S&P moves lower. They're inversely correlated most of the time. But that move was really off the charts. Typically, when the S&P goes down by 1%, we see the VIX go up, call it 2 points. That overnight move equated to a 42-point jump from Friday's VIX close, while the S&P at its lows was down 4%. So that's a 10x response in the VIX relative to the move in the S&P 500. And my friends in the SPX options markets made it very clear that there was no market for those put options Sunday night into Monday morning, and as a result, VIX spiked dramatically. Part of this is very clearly due to this zero DTE option phenomenon where people who want to hedge can hedge, on a specific day, but they have tended to bring their hedges in to very short tenors. With the eruption that we saw starting really Thursday into Friday and over the weekend, there was a mad scramble to hedge further out. And that mad scramble resulted in this massive move in volatility in the VIX. Interestingly, VIX futures, which trade separately, the VIX doesn't trade, for those who aren't familiar. You can't trade the VIX. You can trade VIX futures, and it was interesting to see that the VIX futures did not respond in the same manner.
Jim, how did it respond?
About half as much.
Okay.
So, the VIX futures were saying that the underlying put options, well, and call options, the underlying S&P 500 options were dislocated. Another way to look at that is demand for tail hedging. The nation's tail index measures the demand for 3 standard deviation out of the money put options on the S&P 500. And we saw that double on Friday from very low levels. It had been down in the 8 range, which says, nobody cares about tail hedging. And that had doubled to about, 16 by Friday. And then part 2 doubled again yesterday to, a level that, we have not seen in a long time and doesn't make sense in the context of the S&P being down 8% from its most recent high. So, questions, will the dip be bought? Are we finally in a recession? Stephen mentioned the Somme rule. What is the Fed going to do? Will rate cuts be enough for equity markets? The history of ending a rate hiking cycle is that the Fed moves too late and that the underlying economy is already in bad shape. This time could be different. And as Stephen mentioned, we've got the election that is going to either give us more or less volatility, depending on how that comes out. That's what I've got.
Well, it's a good contribution.
Happy to
Thank
answer
you.
any questions.
Questions to Jim or Stephen or anyone?
Yes, Jim, I've got a question for you. How much was the yen carry trade? How influential was that to this whole drop that we saw?
So that's a great question, Adam. And, it's really difficult to quantify things like the yen carry trade, the dispersion trade, and the dispersion trade, for people who don't know, since COVID, we've had very high levels of dispersion, a lack of correlation between indices, the S&P 500 as an example, and the constituent stocks. And when that presents itself, you have hedge funds who will short index volatility and go long constituent volatility. So I'm short the S&P vol and I'm long NVIDIA vol. And as long as those correlations remain low, then that's been a great trade, and a lot of hedge funds have had that trade on. The yen carry trade is a global phenomenon, but it's been shown to me that quite a bit of it was investors in Japan using the relatively low rates associated with the yen to invest in the Mag 7. And we did see the yen strengthen some in December, but that didn't seem to disrupt things. It would appear that it took a second surge to cause that. And I think the other piece of this is it ain't just one thing. I think what we've seen here, we've seen some dominoes. We've seen the yen carry trade. We've seen the dispersion trade. We've seen vol control funds who had grown accustomed to VIX in the 12 to 14 range, and all of a sudden it pokes its head up, and they have to adjust their portfolios. Same with commodity trend CTA population. We've seen shifts in positioning across a number of different strategies and sources that kind of came together all at the same time.
When you say they had to trade, they had to adjust their portfolios. I'm assuming you're talking about their discipline to their trading methodology, right?
It depends on who we're talking about. If we're talking about dispersion traders,
The VIX.
and the vol control funds, yes, they are basically adjusting their positioning with changes in volatility. If volatility is going down, they're adding risk to their portfolios, and conversely, if volatility begins to move north, they're reducing exposure to risk assets.
Thank you, Jim.
Rob, you have a question?
Yes, thanks, Jim. This is Rob Colorina. I think I see from your signature there that you're in the private wealth space. Are there some thematics that you're sharing to, I guess, the family office private wealth clients that might be different than maybe Steve's positioning at ARS?
Well, Steve has been very transparent, over time about, themes. And I think we probably drill down. We don't drill down as much as ARS might. But, we have been working with clients to make sure that they are comfortable with the risk in their portfolios. And we certainly have tools available. We have spent a lot of time fleshing out exposure to alternatives. That's a whole separate conversation. We are using risk managed approaches to equity exposure. So yes, we're having that conversation, but there's no sort of blanket theme for us. It literally is client by client.
Thanks. Steve, any quick comment back?
I'm sorry, Rob, I missed that.
I was just
Themes.
asking if you had any comment back.
No, I think for us, we're really the same way. We try and make sure people are comfortable with their risk tolerance for where they're at right now, and that's everyone's different. So we look at for some of our clients, it's a good night's sleep. For others, it's maximizing returns. So we'll manage accordingly to that. And it's one-on-one conversations, particularly navigating through the volatility right now, where I think one of the most important things is to not let the short term scare you out of your long term. And what's happened the last couple of days would be plenty to scare people out if they didn't have a base for what they're trying to do. And I think it's really the difference between trading strategies and investing strategies is how you want to think about it. And we think about it as an investment where if we get the themes right for the next 3 to 5 years and back them up with companies with good valuations and catalysts for growth for the next 12 to 18 months, we'll be fine. That's what we've done for our 52 years. So that's the way we look at it. By being high conviction, though, we're out of step. So you have some painful days and some days where you feel like a hero. And you realize you're neither on either of those days. Your process worked at that time. That's how we look at it.
Rob, are you trying to stir a pot here, get a point counterpoint that you're trying to go for?
It didn't work.
I like stirring the pot. I like stirring the pot. You're free to chime in as well.
I actually think one of the things that's not being talked about that's happened since the financial crisis is that I think people are taking doing their tax selling and taking profits earlier than they are. If you're a hedge fund, I think you're taking them earlier in the years than you did in the past. And we had a sharp move like we had up in the first half of the year, and they started to think that they could be losing a lot of their outperformance. I think a lot of hedge funds locked in their gains and sold a little less discriminately because it's about locking in the gains and make sure they're getting their returns that way. And I think we've seen it move up from the fourth quarter, to October, late fourth quarter to October, and then moving it up even into September. And I think what we saw the last week was some of the people doing their work on locking in profits at an earlier level for the hedge funds. So I think that exacerbated some of the selling as well.
I'm just curious, since I'm 15 minutes from the Intel site, with the Intel drop 15%, personnel reductions expected. Any insights on Intel from anyone here?
If
Collective insights.
I'll just give you my view, which isn't our house view, is when I was talking about the guys who can, the guys who can't, the haves and have-nots, I don't think Intel was growing at a rate that was fast enough to allow them to make all the investments they needed to make to compete with the guys who were really rocking the way they were. I think you need both the growth rate and the balance sheet, and I think they've been a little too much on the legacy stuff and not enough on the cutting edge stuff. And I think they got caught up in the overhiring that most of the tech industry did. And I think the layoffs are shocking to people, but I think the hiring the last several years in the tech space was also shocking. And I suspect that most of the people that get laid off in the tech companies will be absorbed into other companies that are looking to get their productivity, but not at the same necessarily comp rates that they were getting before.
Got it.
It does call into question, did the government bet on the right horse with their spend for the Intel plan? But I think that's necessary spend that we had to do. Whether it was Intel was the right one for it or somebody else was a different discussion.
Yeah. Fair enough. Other comments, questions?
It's August, Mark. People are starting to wind down. A couple of weeks.
I can add a sort of anecdotal observation in regards to the Magnificent Seven, specifically in NVIDIA. I was just in Nashville last week for the Bitcoin conference, and we were hearing about Google and other major players coming in with major offers to Bitcoin mining data centers and offering to just shut them down to switch them over to AI data centers. So my investment thesis with my data centers is the canary in the coal mine is what's happening to NVIDIA. I think NVIDIA has grown too much. NVIDIA chips are about as useful as oil stuck in the ground. If you can't get the oil out of the ground, it has limited value. So you can manufacture as many NVIDIA chips as you want, but if you can't put them in a machine and put that machine inside a data center that's powered, air conditioned, and maintain the AI processor, it's useless. So I think that there's been too much of a run up in NVIDIA chips, and there is a scarcity of data centers. The fact that AI processing companies are making offers to a bunch of people who have been hodling their Bitcoin or their machines for the past 2 years or so, and offering to pay out at a premium when every Bitcoin person thinks that Bitcoin is going to at least double, if not triple, and maybe as much as quadruple in the next year or two. That should tell you how incredibly bullish the AI processing sort of sphere is. And put it into context, as far as I know, there is not a single AI company that is profitable in its service. right? Not in selling off, not in an exit, but there is not a single AI company that is providing a service and is profitable in providing that service, primarily because the AI processing is undervalued. It's being subsidized. So that's my insights from a data center perspective, an investor in the data center perspective. There you go.
Appreciate that, John.
I'll just.
Anyone else on that or other topics here?
Yeah, Mark, I was just going to follow Giovanni's comment on the digital mining side, sort of recent conversation along very similar lines. Apparently, the availability of power capacity is so constrained that, you know, to his point, the AI people are willing to pay almost any price for available centers that can provide the processing and have the available power, which is a unique nexus for Bitcoin miners or digital asset miners.
Bill, I didn't see the price movements today, but were you surprised by the price movements in Bitcoin the last 2 days?
Myself? Am I surprised?
Yeah. Giovanni,
Bill?
go ahead. I'll throw in my 2 cents worth afterwards.
Not at all. The fact that there are some sort of waves that have been coming in is not surprising, given that I think that a tsunami is coming in. I would say that the next 12 months, I mean, super conservatively speaking, I think Bitcoin will get to 120, super conservatively speaking, probably around 180, and maybe as much as 240 in the next 12 to 24 months. So the fact that there is some, you know, volatility, minimal relative to where I think Bitcoin will be in the next 12 to 18 months, I'm not at all surprised in the price movements of Bitcoin lately.
And what brings you to that conclusion? What are the drivers taking it to 140 and 200?
Okay. Two things. ETFs have been raising so much money, and by law, ETFs are not allowed to be in cash. So ETFs have been putting in so much buying pressure into Bitcoin that there were many days, not a few days, there were many days in which the amount of money being raised into an ETF was more value than all the Bitcoins being mined that day, which would require for the ETF to buy up every single Bitcoin being mined that day and convince someone who has been holding on their Bitcoin that they should now sell, given that they've been holding through the winter and they think the summer is coming. Number one. Number two, if you look at some of the statements that have been made, at least at the Bitcoin conference, from Trump and from Kennedy, where there is a proposal potentially of creating a Bitcoin national reserve, the way that there is for oil and other strategic assets to America, where I think, I can't remember if it was Kennedy or Trump said that, you know, once they'd achieved a certain mark, they should buy 550 Bitcoins a day. There are only 450 Bitcoins being mined a day. So again, that would be buying every single Bitcoin that's being mined that day, plus buying Bitcoin from people who presently own Bitcoin and think it'll go up. So you know, as Oscar Wilde said, there's no accounting for the public's taste, okay? What they say in the markets is the market can remain, irrational longer than you can remain liquid. I would not, do not stand in front of this mob mentality, this bulldozer that is digital assets, right? I'm not saying that Bitcoin's going to get to 1 million this cycle, but that it will double or triple, maybe even quadruple in this cycle. One last point. Bitcoin is insanely predictable. After 5 market cycles, we can see that from its highs, it can get as low as a discount of 85% in the middle of the winter. And generally speaking, every time it rallies from its low, it appreciates a third times as much as it does in its last cycle. And because Bitcoin has a halving every 4 years, it's as predictable as winter, summer, spring, and fall. Don't print your. Sorry, go ahead.
All right. I just want to make. I love you, Giovanni. I just want to get the other perspectives in. Bill,
This is Rob.
Bill,
Mark,
wait, Rob, just 1 second. Bill, did you want to chime on to that?
Yeah, I think Giovanni put together the bull case very nicely. Certainly the pullback that we saw was it shouldn't have been unexpected because Bitcoin in the short term behaves very much like a risk asset. And I think early on people were quick to point out that Bitcoin didn't correlate very well with like the S&P. I was always highly suspicious of that conclusion because there just wasn't enough data. And I think that what you see is there are a lot of marginal buyers and holders of Bitcoin, and they will tend to react relative to how risk assets are behaving in the general marketplace. So in terms of a very short run behavior, probably a better way to put it, not unexpected at all. So, do I see a potential recovery? Yes. Because I think to Giovanni's point, from almost the onset, the expectations for Bitcoin were for it to follow a wide channel logarithmic value, on up. And so far, admittedly, the channel's pretty darn wide, but overall, it has been mirroring that logarithmic path. So I think that as time goes on, it's likely to continue to do that. And the point about its behavior following the halving, yeah, it's almost doubled like every single time, which is pretty amazing. So there are a lot of drivers that are in there. They're a little bit hard to put your finger on because they're different from typical stocks and bonds and things like that, since it's a non-cash flowing asset. But nonetheless, it seems to be fitting the behavior, albeit with rather significant volatility.
Okay, thanks, Bill. Rob, you want to get a question or comment?
yeah, just a comment and maybe reaction from a couple of the folks. I'm not sure if Steve, you brought it up earlier, but the Berkshire Hathaway sale of their, I guess, 50% position in Apple this past week, how does that play, just given some of the commentary on tech in the last 15 minutes here?
It didn't help. It didn't help Apple, but he had such a big position, and I suspect this is part of the transition that they're doing in their management approach there. Different hands will have different styles. So you don't know if this is the two investors or if this is his successor starting to put his kind of hands on the investment process, because I think his successor was going to have, if Wanda's on the call, she can weigh in on it, but I think his successor was going to have final say on the investments. You just don't know when they're making the transition. I also looked it up to see when the sales were done. Was it the last couple of days or was it before? And I think the numbers, according to FactSet, would say that most of those sales were done in the last quarter before all this decline happened. So I'm not sure it was a factor in what's gone on recently with Apple. So I think that if that's right, I don't think it's much about this, as much about the stock as it is about changes they're making over in their shop. But Apple is one of the companies that's in question. That can they keep their growth rates up and all that? Their earnings were actually pretty good, and they could be a big winner in AI if their refresh cycle, if it drives a refresh cycle for them on the phones. You could have 400 million phones have to be upgraded over the next couple of years. That would give them a pretty good runway. So I think that's really the debate right now with them. Can they get their phone units moving while they're having the other challenges?
Can I ask, everybody, if you don't know, I'm a Bitcoin skeptic. But how would someone sell a large block of Bitcoin?
Define a large block.
How big of a block?
Are you
So
selling?
I see something. No, I see something happening. So it's very large. It's a few hundred thousand.
Few $100,000 worth of Bitcoin or a few 100,000 Bitcoins?
Few 100,000 Bitcoins.
What?
Yeah,
Well, you
there are
could-
ways of selling. I know this area pretty well. Are you asking for actual mechanics, or are you asking for
Like in a
how big?
market, you'd have block trading. It'd be sort of like block to block. You wouldn't hit the street.
Right, you wouldn't hit the street if you're doing
And-
that as a block. Do you
Let's just say it
know?
was, yes, but let's just say it was not 200,000. Let's say it was 10,000.
Right.
How about a 10,000 block trade?
I mean, without making any kind of positive statement, these are happening, and they usually happen in a way whether or not they're using USDT or they're using USD. So it depends on the currency, it depends on the location. And yeah, and then the transactions are usually executed in a private manner and usually tranched. What kind of details are you interested in? And maybe this is a different call.
People can just ping me that there's something I'm seeing, and I'm already skeptical. I'm skeptical on skeptical. So,
Uh-huh.
but you all are smarter than I am. But I know I would appreciate if we can bring it up separately. All right. Well, it's 12:01. I am thankful that we all can get together like we do every week, and thank you, Jim, for bringing your slides and perspectives. And if other people like Jim, if you've got ideas to share, we have deep dives, but just we're a community, so let's keep the marketplace of ideas, John Locke and rolling. Thank you.